Good morning and welcome to the CT UK High Income Trust PLC update and outlook for 2025. Throughout this recorded meeting, investors will be in listen-only mode. Questions are encouraged and they can be submitted at any time just by using the Q&A tab that's situated in the right corner of your screen. Simply type in your questions and press send. The company may not be in a position to answer every question it receives during the meeting itself. However, the company can review the questions submitted today and publish responses where it is appropriate to do so. Before we begin, I'd like to submit the following poll. And I'd now like to hand you over to Managing Director David Moss. Good morning to you, sir.
Good morning, thank you, and thank you everyone for listening to us today, whether that's live or on playback later. Few things to touch on to update you where we are, current positioning, talk a little bit about the UK. I think it's a really interesting time to talk about the trust and to talk about UK equities. Obviously, last year the UK delivered a positive performance, albeit lagging some other markets. We think as we look forward, while there's certainly some issues out there, there's some things that are positive that actually can be positive about as well. And we should be constructive as we look forward. So let's move through the presentation. The disclaimers are at the start. Please read that either now at your leisure. One slide which you'll have seen before. All we're trying to say here is Columbia Threadneedle Investments is part of a bigger group. We're extremely well resourced across all aspects of investment, and that's all designed to be there to help deliver better outcomes for our clients. So, okay, we want to talk mainly today about what's happened in the trust, what we've been doing, but I think we need to actually address first of all this question, because I think this is important. Is the UK, or should we say, still an attractive investment destination? Now, clearly, the economy's been weak. Inflation has remained elevated and probably more elevated in many other countries, perhaps except for the US, which means that while interest rates have been cut, they've perhaps not been cut as much as some would have hoped. Of course, the next rate decision will be in February, and we would expect a cut, but let's wait and see. On top of that, clearly the budget back in October was not what investors hoped for. In fact, perhaps we can say in many respects it was everything investors didn't want to see. But we have to have some sympathy with the new government. They need to raise some new revenue. And unfortunately, they tied their hands behind their back in terms of so many tax rises through the election campaign. There wasn't a lot left to do. So clearly the investors voted with their feet. Bond yields rose quickly after the event, albeit they came down a bit before rising again in January. So it wasn't a great starting point. And that certainly hurt sentiment, and we have yet to see really the impact on business. Lots and lots of companies have told us that they will be reducing hiring or getting rid of more people in response to the national insurance change. But we've yet to really see that impact. So perhaps some things will get a bit worse before they get better. However, I think we have to point out that employment still remains robust. The unemployment numbers are still very low. Wage growth continues. Now, this is a bit of a problem for inflation, but it's coming down. So we're seeing moderation in employment and moderation in wage growth. Clearly not good for anyone who's impacted by those factors, but for the economy and for interest rates, these are not unhelpful. Inflation generally, the lead indicators are improving. I said I'll put there finally. And again, it's slow, but they're definitely getting better. UK mortgage rates look like they may have peaked. Obviously, the move we saw in interest rates or bond yields, at least in January, didn't help, but they've come back down again. And we're seeing 5-year swap rates, which are the driver of 5-year mortgage rates, actually looking at to be at more attractive levels again. And actually, activity in the housing market looks okay. We've seen some of the house builders report so far, and they're sort of, I would say, cautiously confident, partly because no one wants to be too confident at this point in time. So there's some good news, some bad news, and then we come to what do we pay for the assets. One of our views has always been, it doesn't matter how good any asset is, if you pay too much for it, the chances are you won't make returns for your clients. And if you get things wrong, well, maybe you lose your clients' money. Any value metric we want to look at, the UK looks highly attractive, both in absolute terms and relative to other markets. Importantly, dividend yield, the trust is the UK High Income Trust. Dividend yield remains high. We're looking at around about 4% for the all share looking forward. on a PE basis or price to earnings ratio, the market on under 13 times, and that's trailing. That looks really attractive relative to any other market. So the answer for us is yes, the UK is a very attractive destination, and perhaps the volatility we've seen in the last 24 hours, which maybe we'll talk more about later, helps us realize that actually, yes, the UK isn't the highest growth market. Yes, we don't have the biggest exposure to technology, but we can buy some really good companies at really good prices with high levels of income. So let's move on. Let's talk a little bit about the trust itself. Again, we would have shown this slide before. UK focused, predominantly UK businesses. We have a fully covered dividend yield of about 6%, obviously depending on where the share price is, and we look to grow that dividend every year. So our shareholders know that they're getting a level of income now, and that income will grow into the future. As I said, predominantly UK, we can invest a maximum outside the UK to take advantage of any unique opportunities we can only find in Europe. And we discipline ourselves to only invest outside the UK if these are businesses or industries that we just cannot get exposed to in the UK. At the moment, because the valuation we believe, particularly of the UK, is so attractive, we're at the very low end of that range, which is about 2.5%. Importantly, we want to provide a high, it's called the UK high income growth, and growing level of income. So that's the first point. But we want to make sure we have the potential for capital growth as well. We're not just trying to deliver only your return in income. We believe that by buying good businesses that can pay high levels of income now and grow, that also allows capital growth into the future. We do have the ability to use gearing to enhance returns, and we're currently around about 10% geared. And we have a unique share class structure. The ordinary shares pay dividends as income, and the B shares pay as a capital return. Performance has been strong since we changed the manager in July 23, which we'll show in the next couple of slides. So we can see here, year to date, which is 12 months numbers, and 1 year, clearly they're the same because this is at the end of December. Good performance, 3-year numbers and longer term numbers still weak. However, we can see from this, the next slide, that 2024, as we showed just now, has been a good year, and 2023 was also a good year of returns on a NAV ahead of the benchmark. And the manager changed during the middle of that year. So if we were to show the performance since the middle of the year, that would be even stronger. Again, you can see that the longer term performance is determined by numbers further out to 2022 particularly and 2021. So performance, that's what we've delivered in the past. Let's talk about how that performance delivered, what's worked, what didn't work, and how we're positioned for the future. So what's worked for us in the last 12 months? Now, I'm not going to go through all of these, and I'm going to focus really on the biggest positives. NatWest Group is an interesting one. Historically, the trust owned very little in the way of banks. We purchased NatWest at the end of 2023. At the moment, we thought was almost an idea for NatWest. I'm sure everyone will remember the problem the bank had treating the accountant, Mr. Farage, at Coutts. That led to the departure of the CEO and a very weak share price. We met the new CEO, Paul Thwaites, didn't think anything really changed fundamentally, and actually the market completely misunderstood how their hedging policy worked and what that meant for net interest income and profits going forward. Now, this is for the last 12 months, but the performance started at the end of 2023 as well. So a new position we bought in the last 15 months performed very strongly. Cairn Homes, by contrast, is something we held a very long time, but it's only really started to work in the last year. Cairn Homes, you might imagine, is a house builder, but it's an Irish house builder. So they are the biggest house builder in the Republic of Ireland. In that market, they benefit from very strong demand and high levels of undersupply. They also build very high quality homes, which means that borrowers can apply for green mortgages where the cost is slightly lower. The other unique factor of the Irish market is that the government has lots of money. Debt to GDP is very low, budget deficits are very low, and therefore they've been able to invest heavily into developing houses. In fact, many cases, buying those houses off of Cairn in order to deliver housing to the population. So two very, very different periods of holding, but very strong returns. Smurfit Westrock is a business, again, that we've added since the manager change. Smurfit was an Irish-listed packaging company, Irish-listed, primarily European, but a decent business in Latin America. They bought a US rival, although Smurfit was barely in the US, so a rival was probably stretching it. In 2024, a company called Westrock. This was the number 2 player in the US market, but had badly mismanaged for a long period of time. As investors realised the change that Smurfit can make, the share price was very strong. SAP is the last one I'll talk about, mainly because this is an example of those unique businesses in Europe that we cannot get access to in the UK. So S&P is one of the world's largest software companies in the middle of a strong transition to cloud. They are primarily primary historic business was ERP, Enterprise and Resource Planning, and virtually every manufacturing business in the planet will probably run SAP. The beauty of SAP is once it's in, it's very, very hard to change. When business move to SAP, it's a multi-year process, and then it runs every aspect of your manufacturing, of the accounting. It works with the HR systems and all the other systems. So unique business, been growing for many, many years, that we can access by virtue of the ability to invest outside the UK. But perhaps the one I'll touch on, the negatives, Supermarket Income REIT. It's a business that sort of does what it says on the tin. They are a REIT that own a number of supermarkets. The vast majority are leased to Asda and Tesco. It's a very high quality tenants. It pays approximately a 9% dividend yield at the moment, but it's been a very weak performer because it's perceived as being hurt by interest rates staying high for longer. This is true in terms of the valuation, but we're very much focused on the high level of income and the ability again for that to grow going forward. If I move on, I'll talk about the biggest positive and negative positions now, because this is looking forward. This is how our portfolio looks as we move into the year ahead. If we look at the chart, the slide on the left-hand side, we can see the names there. What's I think important about all these names, with the exception of Smurfit and actually Cairn Homes now, because the share price has done so well, these are all high yielders. And in every single case, we see this as companies that not only pay a high yield now, so a high dividend, but that dividend can grow into the future. So helping us to pay that rising level of income for our shareholders. In all cases, the reason these dividends are high, we believe, are not because these are bad businesses, but because they're often in sectors the market doesn't like or understand, financial services. Perhaps they see a business that's sales are deteriorating, Imperial Brands, that's correct, but the cash generation is very, very strong. Or as I said earlier, Supermarket Income REIT was hurt by interest rates. I'll perhaps point to 3 particular stocks here. Phoenix, Legal & General, and M&G. These are all UK life insurers. They all do slightly different things in the UK market, but are treated very much the same by investors, we believe. So dividend yields for these companies ranges between 8 to 10.5%. And each of these cases, the dividend will grow every year. Not by much, admittedly, but we feel this is a sector that's hugely misunderstood, and therefore we get the opportunities to buy really good businesses at great prices and high dividend yields. And that's crucial to what we're trying to deliver for the portfolio. We're prepared to buy businesses where we have a great deal of own research. Our central research team cover all these stocks, and that gives us the confidence to buy businesses perhaps when the market doesn't want to buy them. What have we been doing recently? What have we changed in order to, we believe, drive high levels of income and higher returns in the future? So some of the names are here. BT Group, it's been many years since I have owned BT in any portfolios. It's been a perennial disappointment. For a long time, it was hurt by high interest rates. It's often seen as a pension with a big pension with a small company attached. We think things have definitively turned the corner. The relative new CEO certainly has improved messaging to the market. I think she understands much more what investors need to hear. But even more importantly, that BT's been on a huge investment campaign trying to build up fibre across the UK. It's had the back of the regulator in that. And that's still ongoing. I'm sure some of you have BT fibre, some of you are still frustrated, you're waiting for it. So it's still going, but over the next year or so, that investment will peak. They will still carry on spending billions, but the number will fall. What that means is at that point, free cash flow will jump tremendously. And we believe that cash flow will come back to shareholders in the form of dividends or share buybacks. At a time when the shares, having been slightly out of favour, already yield 5.8%. So a share price where a company, we believe, we get a higher dividend, that can grow into the future. Interesting amongst the buys, there are two types of companies. And I said earlier, we want to produce high level growth of income, but also for the prospect for capital growth. And ASMI and Convatec are two companies which are much more about capital growth. They pay dividends, but they're relatively low levels. ASMI is another European company, and again, a unique business, which I'll touch a bit more on later. And Convatec, a UK listed business with most of its actually sales in the US, where it's been for a period of investment in R&D and now delivers some new products, which we think deliver a lot of growth as we move to the future. Victrex is interesting. This is a business which produces a particular type of thermoplastics patented to them, and where they develop many follow-on products. For many years, this was a darling of the UK market and traded in very high valuations. Expectations probably got ahead of themselves, and the shares had been very weak over the last couple of years as a big build of inventory post-COVID caused them to cut their forecast for some time. Now we have a business where we believe growth can still be very strong in the years ahead, but we're getting paid a very high dividend yield in the meantime, as a market really doesn't believe their growth prospects. We think they're still valid, but at the same time, we're getting paid approximately 6% dividend yield in order to wait. So we're being paid to wait for that growth to come, which we think is a great opportunity for our shareholders. BP's worth touching on. Not owning BP was a strong positive for us last year. Our preference was for Shell, and the performance difference between the two was very strong. As we got to the end of last year, we switched some of that back and started a position in BP. Firstly, the valuation just became very attractive. The dividend yield was over 6%, which is a big premium to Shell. And we're conscious that a new management team and a capital markets day in February means that we could see better times ahead. And we think this is a good opportunity to start the position. It's not a big position at the moment, but it helps to add yield and gives us opportunity going forward. On the sales, as well as we have to be disciplined on the buys to buy good businesses around of favour, we also have to accept that sometimes good businesses just get too expensive. Sage is a UK software company, historically known for its accountancy software, which is now broadened to provide a full back office to small and medium-sized enterprises. The company reported very strong results at the end of the year, and the share price moved aggressively ahead. At that point, we felt the margin of safety just wasn't there anymore, and we decided to sell the shares and reinvest elsewhere. The other three stocks there are all companies where the shares have done very well. Again, the dividend yield that was therefore lower, and we felt the margin of safety was reduced. So we've had a lot less activity in the second half of 24 than we did in the previous year, as we felt the portfolio was in the right position. But we're also cognizant that we need to be active where we can buy, as I demonstrated here, good companies at great prices. We will continue to buy and sell business, and I said same on the sell side. I'm going to talk about a few names now in a bit more detail. Some of them I mentioned already, but we have some specific charts on the company, so I'll go through those. Smurfit Kappa, now called Smurfit Westrock. I mentioned this earlier. It's now become one of the global leaders in paper-based packaging by virtue of the takeover of Westrock. As I said, Westrock was the number 2 business in the US, but had problems for a number of years. What's become clear post-acquisition, these issues were not with the quality of assets, where Smurfit management, having now inspected them all, believe are actually pretty good, but more with the way the business was run and incentivized. Salespeople at Westrock were basically incentivized for volume over value. I sell as much as you can and don't worry about the price. In virtually any business, we know that's a recipe for poor returns. Interestingly, in the US, the number one player, International Paper, had the same model, which meant that while the market structure with three players dominating the market should have been good, returns were not commensurate with this. By Smurfit taking over WestRock and a change in management International Paper, we've had dramatic change in the market structure, where all the big players now are focusing on delivering as much value as they can to shareholders and doing this primarily through price and restricting capacity rather than just producing as much packaging as they can. We believe that as companies demonstrate that they will do this for the years ahead, there's significant upside from Smurfit here. Now, the dividend yield is attractive, but not that high, but it's grown dramatically for a number of years, and we think that will carry on to the future. Although we probably expect more share buybacks here as it's now US listed and UK listed. NatWest I mentioned. I won't talk too much about this. What we think is interesting is that investors have, in the main, failed to recognise that positive interest rates are very important for NatWest, and that the way they hedge these interest rates means that they can deliver mid-teens return on equity for years to come. This is a level we've not seen in UK banks since the mid-2000s, and importantly, deliver this with much stronger balance sheets and much better capital than we ever had before. The valuation is now still attractive, albeit probably not as attractive as it was 12 months ago, but we can see a 4% dividend that's growing and a share buyback program to come. So still an attractive investment, we believe. ASM International, I've talked about, very topical. Our semiconductors saw a lot of volatility yesterday. Again, a unique business you cannot access in the UK. They're a global leader in advanced deposition technology. What does that mean? That's a technology by which the wafers in the chip are built up. Whatever the material is used is deposited on the chip in order to build the chip up. They have a very big market share in that, and they're a direct beneficiary of growing demand and application and adoption of AI. Albeit that's now somewhat believed to be under threat for the comments from the DeepSeek Chinese company the night before last. But we still see very strong growth ahead. The share price fell yesterday, but it's still above levels where we were buying the shares back in September. So a long time ahead and a unique asset we cannot see in the UK. BT I've talked about. Again, interesting timing. It will take a little while, I think, to really demonstrate returns, but we think the business is on a much better track going forward. Convatec I mentioned earlier. So this is a business that was listed from private equity. A new CEO came in about 5 years ago and really focused on investing in R&D, research and development. This is now coming to fruition, and we're seeing lots and lots of new products. They're very strongly positioned in continence and infusion care markets where we see structural growth, particularly in the US. And we think the margin can rise from here as those new products produce better pricing. This gives us the prospect, we think, double-digit profit and earnings growth going forward, and a great way of delivering some capital growth for our shareholders. Said very limited dividend, we think that dividend will grow as well. I'm going to stop there, conscious that I've talked about quite a lot of different companies that we think are really interesting, and I'll pause for questions. I'm delighted to answer anything anyone has. Thank you for your time.
Thank you, David. Yeah, my name is Peter Brown. I work within the investment trust team at Columbia Threadneedle. I'm going to manage the questions coming in. We've had a few come in already. The first one is regarding the gearing. You said it's about 10% of the portfolio at the moment. The use of gearing can amplify returns, but also magnify losses. How do you manage gearing risk while pursuing higher returns?
Yes, I mean, that's a really interesting question. Thank you for that. The easy thing to do with gearing is just to say, well, we think XYZ market's cheap and therefore we'll have gearing. No, we do think the UK, as I said earlier, is a very attractively valued market, and therefore gearing makes sense. But we want to think very much on a company by company basis, rather than a blanket view of the UK. Is can we find enough good businesses that we think it makes sense to deploy the gearing for our shareholders? If the case is yes, then we will do so without any explicit view of the market. as much as I've talked about the UK, we obviously don't invest in the whole market. We invest in a select portfolio of companies with good and growing dividends and all the prospect of capital growth. So if we buy the right companies, if we make sure we don't pay too much for them, then that's what will protect our returns, even with the use of gearing, rather than having a directional bet on the market.
Thank you. Second question, as a smaller trust, what challenges or opportunities does this size present in implementing your strategy effectively?
I mean, in terms of the size, where it's an issue, I guess, is competing against bigger trusts that perhaps are seen as more invested by bigger wealth managers. However, the size is always also a huge opportunity. We can invest in smaller companies if we wish, and that is one of the aims of the trust, is to find dividend income and growth in smaller companies, where perhaps some very large trusts just could not take a position. It also means perhaps it's more interesting for retail shareholders, where the dividend yield is very attractive, and where they still can buy size and liquidity is still enough. So it's finely balanced, I think. Clearly, we'd like to be bigger than we are, but we also believe we can be very nimble with the size of the trust at the moment.
Thank you. Moving on to slightly more sector-specific questions. We've seen the volatility overnight in the tech stocks, and you've mentioned ASMI being within that. What exposure does the portfolio have into tech, and how, I know it's early doors, but how do you see this playing out with regards to possibly the tech darlings losing their momentum and maybe allowing the other parts of the market to perform in the next 12 months or so?
Yes, I mean, our exposure is pretty small. ASMI, as I mentioned, we started buying that in the middle of last year when the shares were under pressure before. And it's worked very well until yesterday. As I said, our last purchase was still below the current share price. We're still big believers in the long-term growth in semiconductors. DeepSeek may be able to do things more efficiently, although it looks like they're probably piggybacking other bigger models. But more efficient will still mean that more things can be done, and that will drive demand, we still think, for all types of new chips. As the newer modern chips use more and more ASMI technology, we think there still remains a long-term growth story. But we'll limit the position as we have done, because we're aware of that volatility. The second company we have is SAP. Again, I mentioned that earlier. Interestingly, SAP is potentially a big beneficiary of accelerating AI. And in fact, they reported results this morning which were very strong, where they talked about that in particular. They don't have their own data centers, they don't have their own LLMs, but they can use other people's. And if a lower cost, higher speed to train the models is the result of DeepSeek and presumably some copycats, that means that SAP will be able to offer service to their customers at cheaper prices. So there's a negative near term and a positive near term, and we think positive to some extent both longer term. The other indirect exposure we have is for other European company, Schneider Electric. Schneider is a provider of basically electrical systems, medium voltage. So they'll provide a lot of the electrical equipment, particularly around efficiency for data centers. And that's a big part of growth. But they're also extremely well exposed to electrification generally. Or whatever we think about whether the growth in data centers will slow or not, electrification is still a theme that's very strong. Schneider has a big exposure. In both SAP and Schneider's cases, these were very strong performers for us during 23 and 24. And as the valuations became a bit more demanded, we have taken profits. So position sizes now are relatively small. But I think one of the things we should think about generally is, one of the oft heard comments is that the UK is less attractive as an investment place because of lack of technology. And again, we think our ability to go to Europe or go outside the UK enables us to capture some of that. But if it does turn out there's a bit of a slowdown in some areas, and investors focus a bit more on the extremely high valuations of US technology, then this can only make the UK look a more attractive place to invest for more investors. And we think that's good ultimately for all our companies.
And staying on the theme of sector exposure, with the increased focus on banks like NatWest and HSBC, how do you manage risk associated with sector concentration while ensuring income stability? And I'm going to marry that with another question come in on NatWest. Have you reduced NatWest recently? It was not in the top 10 disclosed as of the end of 2024.
I'll answer the second one first. So NatWest we did reduce. The shares, as we can see from the contribution, performed very strongly from when we bought them at the end of 2023. So as the dividend yield came down, as a result of the share price going up, we took the opportunity to recycle that into other businesses. And that's something we'll always do. We'll always look to be active where we can, whether because something's done very well or the dividend's gone a bit low because of that share price. We'll look to recycle that into better opportunities. It's in a very important position for us, but yes, not as big as it once was. In terms of exposure to banks, despite the fact that we have HSBC and NatWest, the exposure is not that big. HSBC is a very big stock in its own right. So while we have a position, we're not hugely overweight. We don't have much more than the benchmark. We don't own Lloyds, we don't own Barclays. So we have I think, a good exposure without being too exposed, because I think you're all aware that these businesses, or the share prices perhaps more than the businesses, can be volatile. So we do want to manage that exposure. It's something we're very cognizant of.
Okay, thank you. And a question on Legal & General. You mentioned their dividend, but the question asker has suggested that the dividend of Legal & General is not fully covered. What gives you the confidence there will not be a cut in the Legal & General dividend?
Yeah, I'd have to look at what it's not fully covered by. I suspect that's earnings and the accounting, which I think is one of the reasons I mentioned earlier. A lot of investors just don't want to look at this sector. The accounting is very complex and changes quite a lot. We think about it in terms of capital generation. And in terms of capital generation, we've seen that Legal & General has consistently generated capital in any market condition over the last 10 or 15 years. And they've been growing that. Now, it's true that they will grow that less going forward, because the management and the CEO is relatively new, about 12 months now. He did an article, I think, in the Sunday Times a week before last, talking about the business. Some of that capital generation will now be directed towards share buybacks, as they recognise the valuation is extremely attractive. So for a long time, the dividend, they grew it up between 5 and 7%. That's now much more likely to be 2 to 5%. But we're very confident they will continue to grow that. Really, their biggest business is pension risk transfer. So buying pension schemes off of corporates. That's a business which has some capital strain up front, which is why capital is important, but then delivers earnings for 20 to 30 years. So there's tremendous visibility going forward in terms of the income stream. So very confident.
Thank you. We get to the final question. If anyone's got any more questions, please put them into the chat room. But the last question is on government politics after the budget with the new Labour government in place. Their view on the housing market, and you do have some exposure to that within the portfolio. What is your outlook for the housing market and how that could benefit the portfolio?
Yeah, the portfolio, we have Taylor Wimpey and Persimmon, and we also own the UK biggest brick maker in Ibstock. So yes, we have a reasonable exposure. And having done well post-election, these stocks performed very poorly in the second half of last year. As first of all, we had the rhetoric post-election, how bad everything was. And then, as I said earlier, the disappointing budget. As we look forward, one of the key positive elements of government policy is to increase house building. We, like many other countries, Ireland being the example I talked about earlier, have a structural shortage of housing at the moment. We need to build more houses. I think everyone is aware that one of the biggest problems of the last few years has been planning. It's been incredibly difficult for any housing company to get planning, whether they have to check every environmental issue, or whether there are too many complaints, or whatever it may be. It's not obviously just for housing. There's the oft mentioned story recently of the 100 million bat bridge or bat tunnel they need to build for HS2. So planning has been a big issue, and governments have been very, very clear that this is something they will sort out. Now, on their actions so far, we need to see the evidence rather than believe in the rhetoric. But definitively, there's a shortage of housing. The house builders themselves, unlike any other cycle where they're coming out of, have very strong balance sheets. Normally get to this stage, they've over-invested in land, they need to raise more equity. Not this time. They have decent land banks. They have a lot of capital. They're ready to build. They're paying good dividend yields in the meantime. But we think there's a lot of pent-up demand there. So we're hopeful. I wouldn't say we're more than hopeful at the moment, but again, we're getting paid to wait for growth to return, and it will probably take some time. We will need to see interest rates come down a bit more to really inject some more confidence. If we look at the house price surveys or the comments from the house builders, certainly we're looking a bit more optimistic. Now, clearly that's not hard. I think we built less houses last year than we did in 2009, which again shows the level of construction that's required for the population.
Lovely, thank you. Well, you can see by the portfolio performance over the last 6-12 months, it's really worked out for you, and the dividend yield is also equally attractive. But if we can just get some closing comments from you, then we'll pass back to Investment Company.
Thank you very much, Peter. Thanks again, everyone, for your time. I really appreciate it. I think the comments I'll leave you with would be, again, there's a lot of negative sentiment out there. I wouldn't say believe everything in the press, but negative sentiment provides opportunity. House builders I've just mentioned is a classic example. Sentiment is very negative. The share price has been hit very hard, but actually fundamentally, we don't think anything's changed. The opportunity is still there for these businesses to deliver higher returns in the future and higher dividends in the future. And we can replicate that across the portfolio. So that very negativity that's out there provides us opportunities to buy great businesses at really good prices. And if, as I said, sentiment towards the US turns, I wouldn't say sour, but turns slightly less positive and investors look elsewhere, then the attractiveness of the UK market is there on show for everyone to see wherever they're based. So we think the year ahead from an investment point of view for the trust looks pretty good. Clearly, economically, politically, it's going to be a volatile road. Thank you for your time.
David, Peter, thank you very much for updating investors today. Could I please ask investors not to close this session, as you'll now be automatically redirected to provide your feedback, and all the management team can better understand your views and expectations. This will only take a few moments to complete, but I'm sure will be greatly valued by the company. On behalf of the management team of CT UK High Income Trust PLC, we'd like to thank you for attending today's presentation, and good morning to you all.